Hi, everybody, and greetings from Croatia, from Europe. First of all, thank you for listening and shout out to the organizers for organizing this event. For me, it's kind of hard. Most probably you heard it before, talking to the computer, but hopefully it will not be boring. Today, I will do the introduction of myself, talk about finance and budgeting, and then at the end, I will talk about Funderbeam, which is a global platform for startup and SME, small and medium-sized enterprises financing, where we are not unique. There are literally thousands of platforms all around the world. However, we have two twists of it. One is that we are a global platform, not UK-centric or US-centric. And second one, we cracked the trading part because it's very hard to trade with the limited liabilities companies. However, these guys from Estonia did it. About myself, I started working 20 years ago in banking industry, working for big Austrian and German banks in corporate and investment banking, doing key account financings, M&A business, valuations. I was heading brokerages, custody, private banking, investment funds, and leasing. And after that, I completely switched industry, meaning instead of doing big deals, I started dealing with startups, first of all, as a consultant to European Bank for Reconstruction and Development. And then I was hired by Funderbeam when I'm running the Southeast Europe operations and was heading also the continental Europe operations. So moving to this industry was a huge change for me. In investment world, you would first ask for the financials, for revenues, for the profit and cash flow. However, in this world, there's none of it. So it was kind of hard to actually talk about valuations. And when talking with investors, we were laughing that somebody who has an idea thinks that his company is worth 10 million, $100 million. But it does succeed in certain cases because in the beginning you sell hope, but later on you are trying to have clients, traction, and actually bring value to not just your company, but to the market. So basically, the first topic I want to talk about is how do startups finance themselves. So there are different stages, and each stage has its pros and cons, both to you and to the investors. And the crucial two questions here are for you. Is this the right partner for me? Am I looking only for money or for a partner who can develop my company and help me grow my business? And the second is to understand why is the opposite side investing in my company. So in this presentation, it's not more or less, but primarily I will be taking the view of the investor. So who's on the other side? Basically, the natural steps in life of a startup is bootstrapping, meaning there's no outside money. It's just you and your partner. And if you succeed, and even if you don't succeed, this will be not just the most challenging part of your life, but the one that you will remember mostly. Then comes the triple F, family, friends, and fools, where they put moral investment and you do everything not to lose it because you don't want to be looked upon. Angels are rich individuals who have experience and connections, usually older people who are bored but want to do something. And when I started dealing with startups, many founders approached me and said, oh, I have a wonderful idea. I need $1 million because I want to move from my regular job and I want to splash it on marketing and sales and think that they did their part. But it doesn't work that way. Usually people who have money and who earn money themselves are not easily moved from their money. So basically, they don't want to invest for free, but are making a calculating bet of losing on many deals, but in the end hitting one deal which will bring them 10 times or 50 times their investment and cover all the other ones. And they are, on the one hand side, on the opposite side, because they want to move early, because they want to come to the low valuation. However, on the other hand side, if your business is asking for more money, you have to choose wisely, not just to get the money from investors, but also pick up the investors who have the networking and the ability to help with either advice or with the business setup if they are from the industry. After angels, which are typically people who invest between $50,000 or $200,000, then comes the crowdfunding, where you are ready to present yourself to the public, but you are not too big enough. You are not big enough to come to the next step, to the VCs. In this step, what's important is that it's the first time basically that the market will learn about you. So the way you present yourself on the one hand side is a very important thing, because in all following steps, people will be able to see actually how you presented, what you produced. And in some cases, bad part of crowdfunding is that you are actually talking to the public, meaning if you have a unique product or a unique platform, it's a place where competitors can see you. For example, if we talk about Google, Google was very afraid that Microsoft and others will learn of what they are doing. So they kept their mouth shut until they reached actually $400 million of revenues, which is incredible. Then they approached two biggest VCs who actually did the investing. After crowdfunding as an option come VCs who typically invest, at least in Europe and in Southeast Asia, typically invest between $300,000 and $2.5 million. And here you have to be very careful, because they're professionals with money. They know how things are going, and in their contract, they want to protect themselves as much as possible. So basically, here you get a pile of documents that you need to sign. And in order that it works long term, be careful when reading it and try to understand all the small bits and pieces, because on the one hand side, there are many covenants which in certain cases are not favorable to you, because they can, in certain cases, change management. They can sell the company. They can influence future investments because they have to give approval to it. On the other hand side, you have to be careful here, because you have to look at the vintage of the fund, meaning if the fund is old one and needs to exit, so return investments to their investors within, I don't know, 3 years or 5 years period, that means that they will put you on sale at this period, because they have, it's not their desire, but actually the way it works. Later on, strategic investor, everybody knows what that means. If you're big enough, you come under their radar. And if you are willing to sell the company, you have the option. Exit is all the other ways. Is it an investment fund? Is it an IPO or something else? So when we talk about budgeting, budgeting is for many founders and employees very boring, but it's important, because I put here what I think are crucial things for looking professionals toward the investors. As if you don't do your homework, there is no way professional investor will look at you seriously. There is wonderful ideas, but sometimes it's not enough. Not sometimes, but 100% of the times it's not enough. And no investor will do a work instead of you. So you have to prepare all the aspects for the success and be prepared. With that respect, I put some things that I believe are important, which is less is more. On the one hand side, you want to fundraise as much money as possible. And this is not just typical, but is necessary. However, the way you spend the money is crucial. Usually the next round of financing doesn't come as soon as you think it would, and your company is not valued as much as possible. So less is more means be careful in spending the money. Don't count that the next round of financing will come. On the other hand side, if you think that you have a good company, less is more means take less money, because in following rounds, you will get higher valuation and you will part with less percentage of your company. Prepare business plan. Later on, I will talk about what is important for investors and what is important for you as founders. But basically, with proper business plan, you cover this, you write different aspects of the life of your company and can actually see where you are thin, where you need help from either investors or employees, or where you are strong for presenting your company to investors. So in business plan, it's not just about numbers, it's about strategy, what you are doing, when you are doing it, how you are doing it, what's your market, what's your niche, what are your competitors, how much, and then the prepare financial plan, meaning based on the business plan, put everything in table and try to project the traction. So what is the typical customer that you are looking for? What do you think is typical amount of money you will get from this customer? What do you have to spend to make it happen, either on a product, on technology, on our marketing? And then this is the biggest thing actually, the cash flow. How much money is coming in the company, how much money is going out, and at what time? And then comes the scaling part, because until you have revenues, it's going to be hard to convince serious players to invest in your company. So be careful with the money prior you have the traction. But once you have the traction and once you see that you can grow your business with more money, then it's time to scaling, and time to scale fast. Scaling doesn't mean, oh, let's get $1 million and make one marketing campaign, because that's gambling. Scaling means projecting how much you need for spending on marketing to acquire a customer, and then seeing month after month if it works or if it needs to be tweaked. And once more, nobody will do the job instead of you. There is no investor, no outside party who can do things that you are supposed to do. Important things from the founder's view. So go prepared for the long term. Usually when we see companies, it's, okay, I want to make a product, make a platform, make something, and I don't care about the structure of the company, where it's incorporated, how it will function. But this is, if you want to become a big company, if you don't think about it up front, you will have problems later on. So prepare yourself for the long-term view, meaning incorporation country. You can be incorporated in Georgia, in UK, in the US, in Singapore. However, upfront you have to think about who's going to be your investors, what are their requirements. For example, VC funds in Europe require you to either incorporate in UK, in Luxembourg, or in Netherlands, because those markets have developed legal system for VC investing, and they will not let investment go down the drain because they invested into a company which is established into a country that they can't control legally what's going on. Later on, it's also employee share ownership program, meaning upfront you have to think about how to develop your company, how to retain your best employees, how to organize it. Usually it's 3 or 4 years plan, usually 10%, 20% of the company. And if you don't set it up upfront, Once you get the outside investment from VC or from crowdfunding, whomever, if you didn't think about it upfront, it's going to be very hard to implement it. Capital for growth is clear. Taxes, in certain cases, certain countries are more beneficial to the company than other countries. At the beginning, when you don't have revenues or when the revenues are low, it's not important. But if you believe that you will be a unicorn, it's going to have huge impact both for you, both for your investors, and then for the company itself. And you have to think about what's the market, countries for expansion. Is it Europe? Is it Asia? Is it US? And how best to serve those clients and markets. Structure of the company, procedures, contract with investors, covenants, intellectual property. The sooner you think about them, the better, especially about intellectual property, if that's something that you can protect, plus the covenants. Try to learn more about what VCs and investors are asking, because later on you can't change anything. And what we've seen with companies, it's not that, okay, I just got the investment and now I'm done for a year or two. You're in constant fundraising mode. If you, on the one hand side, if the company is not developing fast enough, you will run out of cash. However, if it's developing faster, then scaling is there and you can get more from getting more money. Decide who would make a perfect founding partner and what are their pros and cons. Because if you get money from an investor who doesn't share your values and doesn't share your development plans, it's going to be like bad marriage. So important things from the investor view. These are the areas where investors want to have information. And if you are not ready for it, most probably, especially VCs, will not think that you are serious enough, especially when you're doing presentations and pitch decks. So history, who you are, what you did previously, if that's of value, is going to have huge impact, because VCs and investors actually invest in teams and not in the companies. Problem and solution are typical questions. What problem are you solving? Is it unique? Did somebody else solve this problem? And what's the solution? Market. If you have a wonderful product, but there is a small market and maybe you limited just to one country, it's not something that outside investors will invest. That's something maybe for your friends. That's something maybe for government support, but it's not something that's scalable. Competition. If many people did already the same product, it's going to be very hard to convince a VC or an outside investor that you are actually the one who will make it better than your competitors, especially if those competitors have huge pile of money in certain countries or certain markets. Traction. This is basically crucial thing for investor. If you don't have any traction, that's a death trap, because investors don't know, is that a right market product fit, or is it just an idea? So Death Valley in this respect is something that serious investors want to avoid, and then they want to come at later stages. Traction here means revenues and revenue per user and how fast you can grow your company. Capital, obviously investors are interested in what you are spending your money. Is it well-being of your employees, so high salaries and good perks, or is it low amount of money for highest impact on the market development? Exit, you have to align here your thoughts with your investors. So if it's a VC who has another 5 years of life, that means that you have prepared yourself for exiting your company and sale of your company within 5 years. And then risks. Investors don't want to think about what are the risks of your company, although most probably they do know it. they want you to present what are the risks, because they want to be sure that you thought about different aspects of your development. And there's team, which is actually, I put it on the last slot, but it's actually crucial. You can have perfect problems and solutions solved. You can have nice market competition, but if you don't have team and if investors don't see that you are long-term for it, that it's not just an idea that you're going to skip next month, it's going to be crucial. Regarding Funderbeam, Funderbeam is a global platform for startup and SME investing and trading. We are present currently in Singapore, in the Baltics, meaning Estonia, Latvia, Lithuania. It's Nordics, Northern Europe. We had projects from Iceland, from Norway, from Denmark. We are registered as an investment firm in UK, so UK is one of our bigger markets, and Singapore, where we within last year got the license from Singaporean regulator to be the regulated market operator. And with that, we have approximately 16,000 investors from 130 countries. So whenever we have a fundraise for a company, usually there are investors from 30, 40 different countries like Japan, Vietnam, Singapore, Norway, Germany, France, UK. So it's all over the world. And what makes us unique, as I said before, we are not just primarily concerned with fundraising, although this was up to now our bread and butter. But what we are interested in, enabling retail investors all around the world to have the access to early stage investing, which was previously reserved for VCs and bigger players, and then not waiting for them to exit their investment when the company is sold. So having a black box for 5-10 years, but that these investors can immediately trade on our platform. And it works like on a stock exchange. You have bid prices, ask prices. You can trade easily because Funderbeam was established in 2013, operative in 2016, where the ex-CEO of Nasdaq Estonia, of the stock exchange, made a platform in a country which is completely digitalized. And actually, whenever we trade or you trade with a stake in limited liability company, nothing changes in the commercial court register. There is no physical signatures or whatever. You just log into Funderbeam webpage, put your buy order, sell order, and you can actually do the transaction easily. So when you want to fundraise with Funderbeam, I'm going to cut it short because you can log into Funderbeam and actually see how it works. But it's preparation of campaign, which usually is a video, and the text, which covers these 9 areas: history, problem, solution, risk, exit, capital market, and what I said before. Video lasts for less than 1.5 minutes because our experience is that retail investors around the world don't want to spend a lot of time for investment of 1,000, 5,000 euros. And actually, one hint for you, even when you provide pitch deck to big VCs, usually they don't want to read 20 pages. If you can't do a summary on 1 page with supporting couple of pages, they'll just skip it. Public campaign lasts usually for 30 days. And after that, if successful, money is collected, capital is increased, and then trading starts with the company. And I would maybe stop here if there are any questions, because I see that we have less than 5 minutes remaining. I can share this presentation. Thank you very much.